All right. Well, I suppose we can go ahead and get started and let folks filter back in when they're ready. I want to introduce Mark Sobel. He's the moderator of our third session. He's been our mystery man because of his sort of delicate situation regarding Senate confirmation. But he is the acting executive director for the United States at the International Monetary Fund, awaiting Senate confirmation. Prior to that, for 3 decades, he was with the U.S. Treasury Department, almost half of which he was the Deputy Assistant Secretary for International Monetary and Financial Policy. And I was fortunate to work with him, under him, for 2 of those many years when he served really as an institution in the Treasury Department, providing analysis on balance of payments developments, managing the Exchange Stabilization Fund, developing foreign exchange policy, formulating international banking and securities market policies. He's really been a central figure inside the U.S. Treasury Department. He's also served as the director of the Treasury's International Monetary Policy and Transition Economy offices and as the assistant financial attaché in Bonn. So I'll turn it over to Mark, and we can start our session 3.
Okay, thank you. Well, this is an incredibly excellent panel, so you should hear from them and not me, so I'm not going to say much, just to say the CVs are in the packet, and rather than covering the CDs, I do want to say that Fred is, Mr. Peterson Institute is the way I think it. He built it, and it's really the leading center for a think tank on international economic and financial issues, and I believe that Fred has created a tremendous global public good that is of huge benefit to the global system. I mean, his writings are extensive, but we're all very thankful to Fred. It's a great honor to be on the stage with him. John Taylor rule. You heard it this morning. You don't need to say anything more than that. I mean, and of course, beyond being a leading edge academic, he worked in the Treasury. He was the undersecretary. He was my boss. He was Russell's boss. And, tremendous accomplishments in his period. I was thinking just a few minutes ago of like some of the things that came to mind, and basically he built up the terrorist financing unit and capacity of the Treasury. He put grants much more centrally on the agenda of the multilateral development banks. He was chief architect of the approach that still exists in the world of the 2 sovereign debt restructurings based on the market-based contractual framework, a speech he gave at the Peterson Institute. And again, as I was mentioning earlier, he was somebody who pushed modernization of governance arrangements, bringing kind of the BRIC countries into the G7, which was a forerunner of where we went years later on the G20. And I'm sure he did a lot more things that he can tell you about, and I could as well. But Joe Gagnon is one of John's students, a longtime Fed and Peterson Institute employee. He also used to be a colleague of mine at the U.S. Treasury, and he's written extensively on exchange rates, international monetary policy issues, trade and current account, forecasting issues, monetary policy. And Agnes Bénassy-Quéré joins us. Now, you're the only person that has not worked at the U.S. Treasury. I think it's because you have the wrong nationality. But,
right nationality.
Or the right one. She's professor at the University of Paris, chairman of the French Council on Economic Analysis. She's an author of books. I have one on my table at home on macroeconomics that she wrote with Bénassy-Quéré and Jean Pisani-Ferry. Longtime writer on the international monetary system, the euro, foreign exchange issues, more generally monetary policy. She told me at lunch how she's becoming an expert on structural and micro reforms. And I recall seeing her years ago giving a briefing to the G20 ministers in 2011 on the future of the international monetary system. So I'm tremendously honored to even be sitting on the podium with this cast of excellent characters. So I'm going to turn to Agnes and Joe, Fred, and John in that order for up to 20 minutes each, and then we'll do what we can in terms of questions if you're still awake.
Okay, thank you very much. Thank you very much for the invitation. So I understand I'm the only European speaker, and coming from the euro area, I must say that it's so nice to be out of the euro area from time to time. It's a breath, and so thank you for the invitation. I also understand that I'm responsible for the gender balance, so maybe I can have a little more than 20 minutes. So in 1985, I was an undergraduate student, much more interested in my friends, going out in weekends, playing music, totally unaware that there was a very important agreement taking place in New York. So I thought I was maybe not the best place to talk about it. So my topic will be more forward-looking, whether the international monetary system is moving to a multipolar system, whether it can be stabilizing or destabilizing, and whether we need more or less Plaza agreements. And I'm sorry that I don't have firm answers to any of these questions, but I try to put some ideas and maybe make you change your minds from time to time. So, first thing, what has changed since 1985? Many things, so I concentrate on two things. First, the global economy has moved to something tripolar, with North America, Europe, and East Asia having about the same weight. Together, they are 75. They account for 75% of global GDP. So this is the first thing. And second thing, as you know, capital mobility, whether you measure it de jure or de facto, you have an explosion of capital mobility over this period. So it changes, of course, what we may think what is good or bad for the international monetary system. But the problem we have in this area is that it's not like monetary policy where you have thousands of data, you can make nice econometrics. For international monetary issue, for the international monetary system, you don't know so many international monetary systems over the past, so it's very difficult to make some statistical inference. So it's mostly about guesses and trying to think with theoretical models. So while the economy was moving, the global economy was moving, the international monetary system was not moving. So I will not go through all these data. You know that the international the international currency plays the role of a medium of exchange, unit of account, or store of value. If you take any of these functions, the US dollar today is still the main currency. Euro is second, but well behind the dollar. So the question is whether this can change or not. So there are two challengers, the euro and the renminbi. Obviously, the euro has some advance, but as you know, is experimenting some difficult times today. And the renminbi is going from far away, but moving very fast. So if you take a few conditions to become an international currency: size, financial, liquid and deep financial markets, nominal stability, strong legal environment, and voice in the international scene. The euro and the renminbi play differently. In terms of size, both are large areas. In terms of financial markets, the euro of course, has much more developed financial markets than China. Nevertheless, the European economy is much more intermediated than the US one. This is why the financial market is not so developed. At the same time, we don't have such thing as the treasury bonds. The euro area is not a federal economy. But paradoxically, the euro area crisis could change these things a little bit. There's a project of a capital market union. I don't know whether it will go far away, but still it's there. And the governance is being changed. That we now have the banking union, so more stability, and maybe at one point we will have Eurobonds. So it's possible that the crisis itself, either it kills the euro, or maybe it will make the euro more attractive as an international currency. Then, in terms of nominal stability, both the euro and the renminbi do comply, and maybe more the euro than the renminbi. And it is on the two last characteristics that the two differ. In terms of legal environment, the euro complies, whereas the renminbi maybe not. And in terms of voice, it's a joke to say that the euro would have a voice because the voice of the euro is completely spread over different countries, and you don't understand how it works. So it's not easy to see which one, or if any of them, will emerge. But what we can say, my take of that, is that there is no such thing as a policy to develop the international status of a currency. If you look at the conditions for the euro to become international, these are the same as the conditions for the euro to survive. So just concentrate on saving the euro and it will be fine. So don't think about anything else, it will come together. So what would be the implication of a multipolar international monetary system for the monetary stability? So there are three popular arguments. The first one is that of Kindleberger, hegemonic stability, the idea that if you have a system organized around one currency, one country, that this country will have an incentive to internalize the externalities related to monetary instability. So they will produce the public good, the global public good, which is monetary stability. And if we have a multipolar system, then this is a leaderless system, and it would be more unstable. So Barry has worked on that. He has strong ideas. It's not so clear, I think, that an hegemon would produce more stability. There are arguments in the other side. The historical experience goes in both ways. And if we look at the dollar, in some cases, the US did play the role of a stabilizing hegemon, but in other circumstances, it tended to rather exploit, I would say, its status. So hegemonic stability, in fact, doesn't provide a very clear answer to this question. Second argument is discipline. So the idea is that if you have competing currencies on the same status internationally, then it's less comfortable for one country issuing an international currency to deliberately continue on an unsustainable path, because international investors will switch to another currency which has the same status, the same qualities in terms of liquidity and stability. So there is no reason to keep stuck on one currency. So this would be positive in terms of introducing more stability, in the sense that it would no longer, in the sense that interest rates and exchange rate would adjust faster if a country, for instance, has too much deficit. And this argument is more and more important when the central country, its weight is lower and lower in the global economy, because you have a rising demand for liquidity, for international liquidity, and you have the same or even diminishing source of liquidity. So then, if you have only a unilateral monetary system, the risk of crash of the dollar at some point is higher. But I would like to focus on the third argument, which is that of portfolio instability. The idea that you have several currencies that have the same status, then international investors will switch from one to the other and back to the first, and this will introduce more instability. I think that two different effects should be distinguished. First, it's true that more substitutability between currencies will involve more what we call portfolio shocks, meaning a change in the allocation of portfolios between the different currencies, and this introduces more instability of exchange rate. But it also means that if you have more substitutability between currencies, then for given shock, you have a milder reaction of the exchange rate, because it's like you have a higher elasticity. So every economist knows that if the elasticity is higher, then the variation in the price that is necessary to absorb a given imbalance is smaller. So I will illustrate this in a minute, and then I will move to a second part where we have to take into account the fact that exchange rates are not just a result of shocks. We have to take into account the fact that monetary policy is endogenous, so we have to take this in the analysis, and this will make me comment on the currency wars that was mentioned this morning. So to illustrate the point about instability, take a very simple three-country setting. So is there a pointer here? Yeah? No. Okay. Here. Okay.
Is there a little pen next to it?
Yeah. Okay. So we have. Oh, sorry. Thank you. Ah, nice. So suppose that the initial wealth of the three areas, US, Euro area, and China, is 100. The exchange rate is 1. So it doesn't matter in which currency it is. Then I consider two alternative shocks. The first one is a transfer from the US, transfer of wealth from the US to the Euro area and China. So there is a deficit in the United States and a surplus in the two other areas. So the wealth of the US drops to 80, and the wealth of the two others increase, and the total is the same. This is ex ante, of course, before exchange rate adjustment. And the second shock is an increase in the wealth of China at the expense of the two others. Okay? And I compare three different international monetary systems. The first one is unipolar with the dollar. So in this case, 100% of US wealth is in dollar because the other two are not international. And as for the euro area, 80% of the wealth is in euro, 20% is in dollar, so it's diversified. And for China, 80% is in yuan and 20% is in dollar, nothing in euro. Okay? So I consider a second possible system where only two currencies are international, the dollar and the euro. It could be the dollar and the yuan, so it would be the same. And a third one where the three are international. And then I compare the global demand for the three currencies, ex ante, so before exchange rate adjustment, in the different configurations. So here I look at a wealth transfer from the euro area to the US and China. So it's a shock that is symmetric between the US and China. Between the euro area and the United States. So here you have the variation in the global demand, so the sum of the three demands for the yuan, for the euro, and for the dollar. So let's start with the symmetric case where we have three international currencies. What we see, so there is, I should have shown that, there is a home bias here, in the sense that the share of the domestic currency is always higher than the share of the other currencies. It's inspired from a paper by Blanchard-Javatiensa in Brookings Papers. The outcome is because the wealth of China increases and the Chinese prefer the yuan, the global demand for yuan increases, and the global demand for both the euro and the dollar drop. Now, consider the same shock, but with two international currencies. Then what happens? You see that the demand for yuan increases more. Why? Because, and this is very important, because both the US investor and the euro area investor don't have yuan initially. So when the wealth of these two investors drops, they don't cut their demand of yuan, because this is not in their portfolio. So you only have the increase in the demand by the Chinese. It's not compensated by a fall of the demand by the euro area and the United States. Nevertheless, the shock is still symmetric for the US dollar and the euro, but with a higher demand for the renminbi. And third system where only the dollar is international And then what do we have? We have a fall in the demand for euro that is more marked than the fall in the demand for dollar. Why? Because the reduced demand of euro by the euro area, because they are poor, is not compensated by higher demand of euro by China, because China doesn't hold euro. It's not an international currency. Okay? So, and we see here that we have, it's a symmetric shock between the euro area and the United States. Both see their wealth diminish, and nevertheless, you have an asymmetric impact on the demand for the two currencies. So here, the euro is going to depreciate against the dollar, even though the shock is symmetric. Okay? To understand, and this is a very general result, and to understand it, let's for a minute consider that in each country, the portfolio is equally divided between the three currencies, 1/3, 1/3, 1/3. Then the location of wealth has no impact on the demand for any currency. So this is absurd, of course, because then there will be no adjustment. But just to understand that the fact that we have more currencies, more international currencies, makes wealth transfers have less impact on the shift in demands between the different currencies. Okay. So then I have a second, so I will not comment in detail, second shock, which is a wealth transfer from the United States to China and the euro area. So you have a deficit in US and a surplus in China and the euro area. So you have a fall in the demand of US dollar, so the dollar will depreciate against the two other currencies. But the shock is symmetric for China and the euro area, nevertheless, in this monetary system where you have two international currencies, you have an asymmetric reaction of the demand for euro and for yuan. So here, the yuan will appreciate against the euro, beside the fact that the shock is symmetric. So you will say, oh yeah, this is too simple. The exchange rate is exogenous. This is an ex-ante approach, and the shares, the portfolio shares, are given. So what we've done with a colleague, it's a paper that is being published in the Journal of International Money and Finance, is that we have a fully fledged model with portfolio shares that are endogenous with rational expectations about the variation in the exchange rate. And we also have a stock flow adjustment. And we consider temporarily negative trade shock in the US, which is symmetric for the euro area and for China. And what we get here, this is the exchange rate of the dollar against the renminbi. So there's a depreciation of the dollar. This is completely what we expect, which is transitory because the shock is transitory. And what we get is that when the yuan is international, so when we have three international currencies, the reaction of the exchange rate is milder. On the other side of the graph, we have the reaction of the euro against the dollar, so the euro appreciates against the dollar. And what we see is that when the yuan is internationalized, the reaction of the dollar against the renminbi and the reaction of the euro against the dollar are about the same. So there is no reaction, basically, of the euro against the renminbi, which corresponds to the fact that the shock is symmetric, whereas when the yuan is not international, there is an impact on the euro-yuan exchange rate. So then we have the same with temporary trade. So what is interesting in this analysis also is that the result is the same if the yuan is not a floating exchange rate when it is pegged to the dollar. We have the same result. So I will move. Now, my final section is about the risk of currency wars. I was very much interested in the discussion this morning, and I think I like the approach of Barry and Jeff about the benign view, which is a benign view of currency wars, saying that this is the result of optimal monetary policies in each country targeted at domestic objectives. And so I like this approach, but then the normal outcome of this approach, if central banks follow Taylor rules, then it should be that if you plot the real effective exchange rate of country has a deviation from its average. So you have PPP in the purchasing power parity in the long term, and sometimes it's above, sometimes is below. If you plot, so this is the real effective exchange rate, and this is the output gap, not the output gap. The output gap as a deviation from the others. Because, of course, if you have a symmetric shock, there's no reason for the real effective exchange rate to adjust. So here you have a very nice graph, I would say, of a very nice, well-behaved exchange rate, which is the US dollar. Why? Because when the output gap is higher than the OECD average, the dollar appreciates in real effective terms, whereas when the output gap is lower than the OECD average, the dollar depreciates. So this is perfectly stabilizing, perfectly consistent with all countries following Taylor rules. Now, if I look at the euro, it's completely depressing. You have the impression that it's moving the opposite way. When the output gap is higher than the OECD average, the euro depreciates, and when the output gap is lower than the rest of the OECD, the euro appreciates. I must say that this is not only because the euro policy is ill-defined, okay. So for the yen, it's even worse. And for the pound, it's not much better. Okay? So now if I take a number of countries, I calculate the correlation over 1995 to 2014 between the real effective exchange rate and the output gap square, the output gap in deviation from the OECD average. I see that some countries are lucky to have a positive correlation. So you have the US here. You have Switzerland, interestingly, and a number of countries, but you have countries in negative territory, including a country with a very transparent monetary policy. So this is kind of puzzle for me, because if you want to have currency peace, you would like to have all countries moving along the 45 degrees line. So something has to be sorted out. I don't have an answer to that. I wonder whether the status of an international currency would help a country to behave correctly, because if you have a funding currency and you cut the interest rate, then you have much more reaction of international flows, and it could help you to weaken your currency. So you have the external channel of monetary policy. But we see that some countries with no international status have also a positive correlation. So I have no clue on that. Maybe you have. So it would be interesting to have this discussion. And then I conclude. Are we moving to a multipolar system? Of course, it's difficult to say. It would be consistent with the evolution of the economy. Perhaps the window opportunity for the euro may not last more than a decade. So if the current difficulties are not fixed, maybe it will be like Japan, like the yen. It will be gone. And for China still needs very bold reforms. So there is this nice volume edited by Barry and Kawai on the renminbi, where it's very clear that very bold reforms are still needed. So I would like to be provocative at the end. Can multipolarity be a kind of substitute for the lack of coordination? If we have less instability due to different currencies corresponding to different blocks, there is less need for coordination. There is less probability of the dollar going to the sky. But there is a risk of currency wars because we have the nth currency problem. So not all countries can have an active monetary policy. Finally, maybe also it would a good outcome of a multipolarity would be to make some currencies emerge as natural correspondence for cooperation. But cooperation for what? Maybe not so much for exchange rates, but maybe to manage global liquidity, which is a big issue today. Do we have too much liquidity in the world? So the risk of financial bubbles and so on. So maybe it would be a shift in international cooperation as compared to with what was successfully implemented in 1985. Thank you very much.
Yeah, and I'd also like to thank the organizers, Russell and Whitney, for putting on a great conference, and Secretary Baker for going along with all this. So Plaza, of course, was about more than foreign exchange intervention, but foreign exchange intervention was talked about a lot at the time and afterwards in the public's eye. And it's what I'm going to focus on solely, exclusively. So a nutshell summary of my paper is here. Sort of as Ted said, if you want to go to sleep, this is what I'm going to say. Basically, in the 1980s, during and after the Plaza and Louvre Accords, many professional economists were skeptical. Like Agnes, I was in graduate school at the time. I had the European friends who bemoaned the very weak state of their currencies at the time, so I was aware of it, and I remember the Plaza in the news. But what we were taught in graduate school was probably this wasn't having very long-lasting effects. The efficient market's view of exchange rates was on the rise. And I, until maybe 2 or 3 years ago, probably would have still felt this way. But I started to look into this, and what I found really surprised me. And this hasn't really come up today yet, but since about 2000, intervention has jumped enormously around the world. It's now running at more than 10 times what it did at its peak in the 80s. I mean, it's just an enormous phenomenon. And suddenly we have some signal in the noise. We have enough information in the data to answer the question, does it have real effects? And the answer is, it has huge effects. It's by far the biggest single factor behind the global current account imbalances of the past 10 years, which in turn are the biggest they've ever been. So my conclusion is that because intervention can be used in a beggar-thy-neighbor fashion, and now that we know it's effective, the temptation for countries to use it in the future in a global slowdown is going to be very high. And we could have really serious beggar-thy-neighbor currency wars, much worse than we've seen, and I think we need rules on that. Okay, so I'll skip the obligatory exchange rate chart. Let's go right to intervention. So what I'm showing here is net purchases of dollars in foreign exchange reserves by the G7 countries. Now this is measured by the flows, the balance of payments flows in the IMF data, so it is purchases of non-US G7 countries of reserves minus sales of reserves by the US. So now that does assume that the non-US countries are operating mainly in dollars, which I think is true. And it also includes, the one difference from the normal intervention data you see is that I'm including interest earnings on the reserves because that's the way the data are refined. You could think of earning interest as sort of an automatic purchase of reserves that happens. But it's not counted in the strict definition of intervention. Anyway, these are annual data. What you see at the time of the Plaza Accord is indeed, it's hard to see, but there was some slight sales of dollars in 1985. It's very small, just barely visible. If you look at quarterly data, you'll see that around the time of Plaza, the last couple quarters of 85 and the first quarter of 86, they were more substantial sales, but already by the second quarter of 86, these countries had gone back to buying dollars. And then around the Louvre Accord, as people have said, and by the way, this chart's very consistent with Chaka's chart. By the time of the Louvre Accord, though, there were huge, by that, record-breaking purchases of dollars at that point. Later on, you see, however, there were some even larger purchases in 2003, 2004, and 2011. Those are pretty much all by Japan. Now, the interesting thing is that, the G7 has been overtaken by events. It is just not that big anymore in the world. So what I have here is a sum of foreign exchange intervention by all countries in the world. And I'm including, because for the portfolio balance view of intervention, it's not just foreign exchange reserves that matters, but it's everything governments do with official assets and currency. So it includes sovereign wealth fund flows, and it includes borrowing, which is a negative foreign official flow. I call them net official flows, which is the net of what governments are doing in currency markets around the world. Most of it is reserves, but not all. So the dashed line is in percent of world GDP. The solid line is in dollars. This peaks in 2007 at $1.5 trillion. The biggest year ever for G7 intervention was Japan in 2003 at about $150 billion. So the peak for all countries is 10 times the peak for the G7. Okay, so that's the big lesson to learn. And this has tapered off a bit since 2007, but it's still hanging in there pretty high. So it seems to me that this might actually have something to do with the global current account imbalances. What I've done here is added up the data just for countries that have a current account surplus. So it's half of the imbalances, the surplus half of the imbalances. Each year, every country that has a surplus is added up. The dashed line is their current account surplus. So that's a measure of the size of the imbalances around the world. And then the solid line is their official flows. It's their foreign exchange intervention, broadly defined, as I said. And what you see is at the time that current account balances grow enormously to an all-time record, intervention for official flows also jumps to an all-time record. So it has tailed off a bit since then, and the most recent year we have complete data is 2013. But as of then, you can see it was still running at very high historical levels. Okay, so, but it is important, sort of, if you want to go, you could say, well, that convinces me that it's important. But if we think about it more carefully, intervention could be causing imbalances, but intervention could also be caused by imbalances. So when a country goes out to intervene, it can push down its exchange rate, and that could create a current account surplus. But if a country cares about its exchange rate, sometimes, and if it has an export boom, that pushes up its current account. It also puts upward pressure on its currency because it's creating more demand for its currency. And officials might resist that through foreign exchange intervention, which would then say the causality would go from the current account to foreign exchange intervention. Well, in the second case, you kind of have to ask the question, well, what would happen if they didn't intervene, if they let the exchange rate go? And there's two possible extreme answers. One is the efficient markets answer, which is that there would be no difference, that governments are fooling themselves if they think their intervention affected the exchange rate, and the private market would step in and do it if the government didn't. So it would still have a current account surplus. Now, the portfolio balance view, by the way, which was the model behind Agnes's paper you just saw, says that it matters what currencies people have, and investors care about the portfolio, the currency breakdown of the portfolios. And in that world, it could make a big difference. Okay, so what I'm going to do is try to focus on the first case. Okay, but what you need then to focus on the first case is you need, in the language of statistics, you need instrumental variables. You need to exclude the examples where the causality was going in the second direction. And that, by the way, is sort of obviously China. If you think of China, which was trying to hold down its exchange rate appreciation in the 2000s, the increase in China's exports was driving the intervention, and that was driving what was going on. Now, I would argue that if they had not intervened and they let the renminbi rise, they wouldn't have had such a big current account. But if you believe in efficient markets, you might not believe me. So I'm going to try to exclude those kind of observations from the analysis and show you examples where the country was not responding to exchange rate pressure. So we use instruments. These are two in my latest work, which I like. The instruments are that you responded to a currency crisis in the previous 3 years, or you look at the non-reserve part of official flows, which don't respond, which in most cases aren't responding to exchange rates. So now, I'll have to leave aside, for time purposes, more defense of what all this is. But I've got some papers that use other instruments, completely different set of instruments, and you get rather similar results. So it's not critical which instruments you use. And But one thing I should say is that most people, when they talk about the effect of intervention, they look at, well, what does it do to the exchange rate? And we've heard that a lot today. But the problem with exchange rates is that we just really don't have good models of them. We don't understand them. They're very volatile. We don't know. There's unobserved things that affect them, things like trade barriers and financial market fads that move them around in ways we don't understand. We can't model them well. And so there's so much noise in exchange rates, it's hard to see what intervention could be doing. Although, recently, as I was writing this paper, I found a new paper that is finding some strong evidence that intervention does affect exchange rates. So it may be possible. But what I've chosen to do instead is look at, does intervention affect the current account? Because ultimately that was driving a lot of the concerns about exchange rates anyway at the Plaza, is what was going on with the current account imbalances. So the idea is that intervention affects the exchange rate, which then affects the current account. Okay, so this is the results of a regression of current account balances on the variables on the left. Okay, and I'm not going to have time to go through all of them, but the two important points to note are, first, that it matters a lot how much capital mobility there is, how countries are free to borrow and lend abroad. A lot of countries have legal restrictions on that. And if a country has very tight restrictions on capital mobility, then it must be the case that intervention must matter a lot, because the private sector cannot undo it. And in fact, all the current account must be financed by the government's actions. So in that case, you'd expect intervention to have a very large effect on the current account. And in fact, intervention would equal the current account in the extreme case. But as capital mobility increases, as financial market depth increases, that should go away. And then you're left with possibly a portfolio balance effect. Well, so we ran a regression, and what we find is that indeed, for countries with the lowest capital mobility, almost nothing matters much. Energy exports and fiscal have a little effect, but it's not very big. And what really matters is intervention, net official flows. And that gets a coefficient of 0.72, which is less than 1, but highly significant and quite large. And that's for the low capital mobility countries. Now for the high, and China, by the way, is a low capital mobility country. For the high capital mobility countries, which includes the US, a lot of things matter. And that's as it should be, because there are reasons people have for borrowing or investing abroad or saving abroad or at home, and they do matter. And as they start to matter, noting particularly fiscal policy matters, so that's quite a nice result, official flows matter less. Instead of 0.72, they matter 0.33. So that says 33 cents of every dollar spent on intervention shows up in the current account. It's still a pretty big effect, and probably bigger than most economists would have expected. And this is for the highest mobility countries. For most countries, it's somewhere in between. Finally, one other note is that the stock, what you did of intervention in the past, piles up as a stock of reserves you're holding. And that stock has a lingering, permanent effect on your current account. And this is a small number, 3%. For every dollar of reserves you have, your current account is larger by 3 cents every year after that. That is a small effect, but reserves are quite large, and it can be big in some cases. And it definitely reflects a portfolio balance view, which the government has taken on a lot of currency exposure off the private sector, and that affects exchange rates, which last. Okay. So these are sort of, interesting results, I think, but it's just a page of numbers. So I wanted to just show you a few cases to try to convince you that really, indeed, in real-world situations, what's going on is really intervention driving current account balances, and not vice versa. And so the first case study I have is Norway. Norway started to float in 1993, and it has reserves, but they don't buy or sell many reserves in this period. They're a very clean floater in this case. They're not responding to exchange rate pressures. So the question is, what happens when they set up their sovereign wealth fund and they start to save a lot of money abroad? Well, they started putting money in the sovereign wealth fund in 1996. That's when the dashed line starts, right here. And already their current account, the solid line, jumps up. And then it really follows the official flows pretty well. And it follows oil exports too, to some extent, because oil exports are a big driver behind the sovereign wealth fund flows. But it really is closer to the sovereign wealth flows, not the oil exports. And in fact, you can see that there's a gap opening up between the oil exports and the current account, which corresponds to what they're doing with their sovereign wealth fund. Again, so this is the case where they decided to save for future generations. They weren't responding to the exchange rate, and they got a big increase in their current account. Another case, Morocco. In 1976, the Moroccan government launched a massive program of borrowing to fund big development projects, over 20% of GDP in 1976, which continued and then diminished over time. Well, it's fair to say that these investments weren't totally successful, and Morocco wasn't able to earn enough returns to pay them back, and they had to have their debt restructured. Over time, they switched to in the 80s, they made a transformation around here towards an IMF program, and they eventually got on Brady bonds, which initially were the result of a program from Secretary Baker, the Baker Plan, who started all this. Well, his plan bore fruit in the Brady bonds, and Morocco got them around here. But what you see is that the development loans really sucked in a lot of imports, big current account deficit. Then as they borrowed less, the current account deficit disappeared over time. Morocco, the IMF said, had a quite flexible exchange rate during this period. They switched to a fixed exchange rate just after the end of the chart. The external borrowing was the entire official flow during this period. Reserves were very small, are the very small difference here. They weren't doing much with the exchange rate. But suddenly, when they went to a fixed exchange rate off the chart, then they started doing more with their reserves and managing their exchange rate. But they were not doing that here. Okay. Finally, Korea. I think Korea is really the most interesting case. So coming out of the Asian crisis, Korea had a big current account surplus of 2% of GDP, which gradually dropped to about 1%. They were piling up reserves because they had diminished them in the crisis. They wanted to build up a war chest. But that tailed off too, and looked like they were coming in for a nice landing. Well, then in 2003, they got a big boost of exports, and it continued in 2004. And this boost of exports pushed up their current account. It also put upward pressure on their exchange rate, which is this dotted line. And the government resisted it by a massive increase in foreign exchange intervention to an all-time record of 6% of GDP in 2004. Okay. So this is exactly the endogenous thing I was telling you about, where the exogenous export boom causes the government to try to stabilize the exchange rate and respond. So this is what we don't have in our regression, but it was true for Korea. But then something interesting happened. In 2004, opposition politicians started criticizing the government because they said, look at all these reserves you're buying. The dollar is falling against the yuan is rising, and we're losing money on those reserves. So people got angry, and it was a big issue in Korea in 2004. And the Korean government then said in 2005, in response to this political pressure, we're going to change policy. We're going to stop stabilizing the exchange rate. And look, they stopped intervening, or dramatically reduced intervening. They let the currency rise much faster. Notice that it starts picking up even stronger when they did this. And lo and behold, the current account comes down. So this is the point, that if the question, what if you didn't intervene? What would happen to your current account? Well, Korea made a decision in 2005, we're going to stop this, we're going to not intervene, and lo and behold, the current account comes down. So I think these three cases show that the statistics aren't lying, that it does matter a lot what you do with foreign exchange intervention. It matters a huge amount. Okay, so just to illustrate, for the latest year I have data for the countries with the 8 largest current account imbalances, surpluses in the world. These are their current accounts excluding investment income, which is because the regression didn't include investment income, but it's a relatively small exclusion. These are the countries with the 8 largest current account surpluses. They totaled $735 billion, and this is in 2013 after we said the imbalances had narrowed. Well, they're still pretty big, and this is just 8 countries. The model that I showed you in the previous table would have predicted almost the total amount of current account surpluses, not quite, but the model is not perfect, but it's pretty good. Of that $657 billion, $400 billion is from the reserve accumulation intervention, net official flows, and about $85 billion is from the stock of reserves, which is pretty important for open countries like Norway, Singapore, and Switzerland to have big stocks of reserves. And this is the mobility measure of capital that we use in the regression. Anyway, the bottom line is that $485 billion out of the 735 billion of surpluses can be explained by foreign exchange intervention policy. This is a huge amount. It's not everything, but it's by far the single biggest factor. So quickly, so some people have said, isn't monetary policy just like foreign exchange intervention? They're both parts of currency wars. Well, they both affect the exchange rate, but I would point out that monetary policy has offsetting effects that mean that in some models it's roughly neutral. And the key point about monetary policy is it's targeted towards domestic concerns and it's conducted in domestic assets. Foreign exchange intervention has no offsetting effects. It's a pure beggar thy neighbor policy. And moreover, it's conducted in somebody else's assets. So it's a cross-border policy. It seems to me that that element of intervention, the cross-border nature of it, is why we need rules for that more than even for monetary policy. So what rules should we have? Well, it seems to me that a minimum standard would be that if you have, and I guess this was my question to Jeff Frankel this morning, for those of you who are here, if you had a level of foreign assets held by the government that was more than sufficient for future crises, and you had a current account surplus, that you should not be allowed to buy anymore. You have no business holding your currency down anymore at that point. You already have a surplus and you have a lot of reserves. Now, you could make an exception for oil exporters, non-renewable resource exporters, I would argue, but not unlimited. A number of oil exporters are saving 100% of their net oil revenues, net of costs. And that's just too much. I mean, you should be consuming at least some of your oil revenues. You should also be saving at least some of your oil revenues at home. So you shouldn't be putting all of it abroad. But you should be putting a lot, especially if your economy is small relative to your oil sector. So that's fine. And then you could have symmetric rules for deficit countries. And this would be consistent with the IMF's Article 4. It's the spirit of IMF Article 4. There's just no enforcement of it. But this is what I think we should see as a minimum. Now, could we do more? Well, there's a proposal from my former colleague, John Williamson, that maybe we should have foreign exchange intervention when exchange rates deviate from some range. And I think the ranges would have to be pretty wide because, as we've heard today, it's hard to get agreement about where exchange rates should be. But if you had really wide ranges, maybe you could get them wide enough that everyone would have their preferred exchange rate somewhere in there. Anyway, the idea would be that if you exceeded those ranges, maybe you should actually intervene to push the exchange rate back. Now, I would have no commitment that you would meet those ranges. I mean, I absolutely think we should not commit to something you might not be able to do, but you should commit to maybe taking some steps to try. And you absolutely should not sacrifice monetary policy or fiscal policy, frankly, for this. But it's something you could do at the margin that would be, I think, stabilizing. And presumably these ranges would be based on keeping current accounts in a small range, because I think large imbalances, I think, have shown to be damaging, not least because of protectionist pressures. And this is, I think, what Plaza and Louvre really were all about. So I'm not asking, I don't think it's much more, but it just needs to be done on a global, wider scale. So finally, in conclusion, I find that foreign exchange intervention, especially defined broadly to include sovereign wealth funds, is a major cause of recent global imbalances. It's also a useful tool to counteract imbalances that might arise from other factors. And here I think I need to point out that, the past year and a half, things have changed a lot, and I don't want to pretend I don't know this, that right now imbalances are declining further, and intervention is declining further. And in fact, it's reversing for many countries, although not all. And this reflects other factors going on, the cyclical policy divergences across countries, as well as some countries' financial markets being concerned about the policy frameworks in some countries. So intervention has dropped off a lot this year. But it doesn't mean it's going to be gone forever. And I do think that eventually there'll be a change in the financial market situation. I think if we get into another global recession, in the situation in which countries now see that this policy tool works, and this policy tool can be powerful, that they'll be very tempted to use it and abuse it. And I think that's the worry. Thank you.
Let me start by adding my thanks to that of my colleagues on the program today, to the Baker Institute for hosting this, to Russell for organizing it so effectively. I'm delighted that I've been asked to co-edit the volume that comes out of it with Russell. We'll publish it at our Peterson Institute. I remind all of the authors to get the revised copies of their papers to me and to Russell by the end of this month so that we can then move it quickly into publication. Thanks to all of you. This session is forward-looking, and so I won't spend much time on the past. I will simply reiterate, as I do in my paper at more length, that the Plaza Agreement really was a unique historical event. It succeeded. It brought the dollar down by 50% against the yen and the Deutschmark. It took the U.S. current account to balance in 5 or 6 years, as Secretary Baker said this morning, and it largely quelled the enormous protectionist pressure in the Congress that was so widespread in the middle 1980s. It was also unique because it was genuinely cooperative. We've heard lots of testimony to that effect from the participants today. I think those two things, which were both rare in and of themselves, and particularly when combined, something that worked and was internationally cooperative, it's been hard to duplicate that before or since, and I think that really does indicate why the Plaza was such a unique historical event. In my paper, I draw half a dozen lessons from the Plaza experience, the Plaza Louvre experience, and I would only mention two, which I think are particularly important. One is that the United States must lead. When you look at the whole history of international monetary cooperation efforts, there is no example of successful international cooperation not led by the United States. Now, going forward, the question is whether the U.S. can still do it. And that was raised to some extent by the last panel. We've moved into a multipolar world economy. The U.S. share is not what it was. And Utsumi-san was stressing that in some of his remarks earlier. But it's clear that nobody's in a position to replace the United States. So then you have to have either international cooperation, or you have to face the fact you may have a leaderless world, what some of us call a G0. No leader at all. And that's a big risk. My old professor, Charlie Kindleberger, has already been mentioned by Agnes. Kindleberger argued that the Great Depression in the 1930s was due to a similar situation. When the UK had declined and the US was rising, but as he put it, the UK was no longer able to lead, and the US was not yet willing to lead. So some people hypothesize in today's world, the U.S. may not be so able to lead. China is clearly not yet in a position and not willing to do so. So could we face a leadership vacuum in which international economic instability becomes more widespread? That, I think, may be the big risk. It points to the critical importance of the systemic transformation that we're now going through, from U.S. leadership, G1, if you will, to a multipolar system. Will we be able to find a way to get cooperative leadership, a la Plaza, probably of a different nature specifically, that will be able to fill that vacuum in a constructive way as needed? The second lesson I would draw from the Plaza Louvre experience, mentioned it briefly this morning, is how domestic politics often drive all this. Most international economists spend their time worrying about international financial instability, that a currency is going to be driven down by speculative capital flows or capital flight from its own residents, et cetera, et cetera. We can conjure up all sorts of images. But in fact, policy changes like the Plaza, and that was clearly the case here, are driven by domestic politics, particularly trade politics, where a currency, as in the Plaza case, got grossly overvalued, hurts the competitiveness of a lot of your tradable goods sector. They, in turn, put pressure on the Congress. The Congress reacts the only way it knows how, which is to raise trade barriers, and you're off to the races in terms of disrupting the international trading system. Again, happened in the 1930s, was threatened in the middle 1980s, but they headed it off. And I'll mention in a moment, that is a current threat. absolutely no doubt about it. It is a current threat and needs to be responded to effectively. But that's a second lesson, that the domestic politics may be as great or greater a source of unsustainability of international imbalances as the risk of international capital flows disrupting and driving down a currency that has become overvalued in a kind of hard landing scenario. So, with that as background, our topic for this panel is the implications for current policy, and I entitled my paper, Is It Time for a Plaza II? So that's the question. Is it time for a Plaza II? Well, the imbalances, the famous imbalances, the U.S. deficit, the other people's surpluses, back about 7 or 8 years ago, in the middle part of the last decade, rose to a level double that of the Plaza. When these guys were dealing with it, it was chicken feed. The U.S. deficit hit 3% of GDP. The German and Japanese surpluses climbed up to 4 at a maximum. That was chicken feed. Back in 05-06, the U.S. deficit hit over 6%, 6.5% of GDP, more than double. The Chinese, now the surplus country, hit a surplus of 10 of their GDP, unheard of, more than double that the Germans or Japanese ever hit. The imbalances were much, much greater. And a lot of protectionist pressure built up, mainly against China. There were threats of import surcharges. But then, fortunately for these purposes, the Great Recession hit. Not so fortunate in broader terms, but for these purposes. And then the imbalances came down substantially. Everything, of course, went to try to recover the world economy, and so the need to deal with the imbalances disappeared for a while. Very interestingly, those of you who've read it, Secretary Baker published his memoir in 2006, just as these imbalances were hitting new record highs, and he said in there, we need a Plaza II. We need another round of international economic cooperation. Well, as I say, the imbalances then came back down. But today, they are headed back up. They're not too high right now in 2015. But if you take a reasonable forecast in the IMF, we've modified it some at our institute with Bill Klein's models, the imbalances are headed back up. The U.S. to well over 4, the euro surplus now headed to 4 or better, Japan back to 3.5 or 4, China not as much as the others, but 2.5 or 3. Those numbers translate to a U.S. deficit of $1 trillion a year, euro and Chinese surpluses of $500 billion a year. So the numbers are very big. They imply huge capital flows, need to finance, but they also then compare very unfavorably with the IMF's own notions of what constitutes equilibrium. The IMF staff now does an annual pilot external sector report. And they say, well, the U.S. should be running some modest deficit. That's contentious, but they say about 1.5% of GDP, but we're headed to 4.5%. The euro area can run a surplus of maybe 2, but it's headed to 4. China and Japan should have balances. Japan, however, is headed to surpluses of 3.5, China to 2.5 or 3. So big imbalances are in the works. They imply substantial misalignments in the underlying currencies. So I took Bill Klein's motto and did a few calculations, and they suggest the following. I don't have slides, it's in my paper. The dollar looks like heading toward an overvaluation of 20 to 25%, which compares with the 30% that it came down after the Plaza. The euro is headed toward an undervaluation of 20 to 40%. That compares with 50% that the Deutschmark came down at the Plaza. The yen is headed toward an undervaluation of 40 to 50%, compares with the 50% it came down after the Plaza. So in short, the potential misalignments are in the same ballpark as they were at the Plaza. Not to mention that the dollar may go up a lot more. The U.S. is growing considerably faster than the other industrial countries. China's slowing down as well. The Fed is in monetary tightening mode, and whatever the timing, will be moving in a tightening direction, whereas the other big countries, Europe, Japan, now China, will all be easing further because of the weaknesses of their own economies. The market consensus is the dollar is going to go up another 5 to 10% over the next year. Some market analysts think the euro and yen are probably headed back toward their record lows. In short, big new misalignments, big new imbalances are probably in the offing sometime within the next 2 or 3 years. However, and so on that basis, you might say, well, there is a case for a Plaza too. You might need to get together and work out some correction of these imbalances. But there's, of course, 2 huge arguments against it. One is, as I imply, the reason for the big imbalances is the relative economic success of the United States. The U.S. economy is doing much better than the others. The U.S. is in a position to begin normalizing monetary policy at least a little, whereas the others are still in full-out expansionary mode. And so it would be hard to imagine the other countries agreeing, a la Plaza, to a currency arrangement that pushed their currencies up and brought our currency down. So the underlying dynamic that the Baker team was able to exploit to organize the Plaza is, to put it mildly, not present, indeed somewhat to the contrary. Likewise, the second driver of the policies of the Baker team and the Plaza, the protectionist pressure, has at least for the moment been quelled. I'm going to mention in a minute, my final point, recent big debate in the Congress about all this, and there have been some changes, but for the moment, at least I think, the risk of a big outbreak of trade protection has probably been overcome, and therefore you don't have that domestic political unsustainability risk that I mentioned before is often the big deal. So let me finally just make a few remarks on that congressional situation, because I think that's of consummate interest, and a lot of people, even who are close to it, don't understand it too well. Actually, earlier this summer, we had in the Congress the most intensive debate about currency policy in the U.S. since the Plaza Louvre period. The Congress intensively debated the currency issue and argued that changes were needed in U.S. currency policy for the reasons I mentioned: the buildup of these imbalances, the adverse effect on the economy, the political pressures that emerged from that. And so there was an incredibly active debate. Again, in my paper, I give a lot of angles and elements to it, but again, 2 were most interesting. One was a very strong congressional push to link currency policy to trade policy. And there was a big push to actually require the administration, who are now negotiating the 2 big mega-regional trade agreements, Trans-Pacific Partnership, Transatlantic Trade and Investment Partnership, TPP and TTIP. There was a big congressional push to require the administration to include in those negotiations, just like tariffs, just like quotas, just like intellectual property protection, currency arrangements, to oppose and try to bar other countries from doing what Joe Gagnon has outlined, intervening massively, currency manipulation, to keep their exchange rates from rising, to keep the dollar high, therefore to build up the trade imbalances. Paul Volcker has famously said, trade flows are more affected by 10 minutes of exchange rate movements than 10 years of trade negotiations, which is about correct. And so it's quite logical, in my view, to put currency issues in trade policy context and even to put them into trade agreements. The reason it appeals to the Congress so much is that they view currency manipulation, direct intervention, like by China, to, again, to keep their currency from rising, to keep our currency from falling, thereby to expand their trade surplus and their competitive position. Congress views those practices as unfair trade practices, just like high tariffs or just like import quotas. And in fact, I think they're right. I think the Chinese currency manipulation has been the most protectionist policy adopted by any country in the world in the post-war period, because it shifted huge amounts. Joe's data show it, hundreds of billions of dollars of trade flows from the U.S. and other deficit countries to China and some other surplus countries. It's a huge distortion of international trade and thus for a grossly unfair trade practice. So the Congress wanted to link currency issues to trade policy. In the past, they've always been kept separate, largely for turf reasons. Mark and his colleagues at Treasury handle currency. The USTR folks handle trade. They don't talk to each other very much. The IMF does currency. The GATT does, WTO do trade. It's different for silo and turf and jurisdictional reasons, but that's not a very good answer. So one fascinating element, which will continue, was this linkage. The second was that the Congress made a very clear distinction between currency manipulation, i.e. intervention, as Joe has described, and exchange rate movements driven by market factors. Now, I mentioned before that the dollar has now risen so much against everybody, mainly because the U.S. economy is doing better and because U.S. monetary policy is at a different position than that of the other major countries. That's a macro and monetary driven imbalance, which is what they faced at the Plaza. In the run-up to the Plaza, nobody was saying that the Germans and the Japanese were manipulating their currencies. In fact, there were huge differences, mainly the high interest rates that Volcker talked about and the Fed was carrying out at that time, coming off the anti-inflation requirement of the early 1980s. But those were macro and monetary driven imbalances, which led to the big protectionist reaction to Congress, which led to the Plaza. This time, it was totally different. Just as the Congress was getting into the trade debate, the dollar was into this very rapid appreciation for these macro and monetary reasons. I can tell you, because I did dozens of briefings of all sides of the Congress on this issue, they paid zero attention to it and had no interest in it at all. They had a huge interest in the currency problem, as I say, but totally devoted to manipulation and intervention. I don't know if they understood Joe's regressions, but in essence, they were buying his argument that the big source of the imbalances in this period were the unfair trade practices, the intervention, the manipulation by China and a large number of other countries, as Joe showed. In fact, Joe's work, and some of which I co-authored with him, were cited very widely in the congressional debate and letters that the congressman sent to the president and secretary of Treasury to say, do something about it. So there was a very hot debate in the Congress, the result of which, and Jeff Frankel was all worried about that, I tell him he can relax because the outcome was actually fairly benign, at least so far. There was a big effort, as I said, to force the administration to put binding enforceable obligations into these mega-regional trade agreements. That came within 3 votes of passage in the Senate. Never came to a vote in the House because it didn't pass the Senate in the first place. Came very close, but it was rejected. And so instead of that, the Congress voted some negotiating objectives, which said, you, the administration, as you negotiate these trade agreements, have to make sure, but that's up to you how to do it, that your counterpart trading partners do not manipulate their currencies for unfair trade advantage. The result of which is that the Treasury, and Mark can talk about it if he wants to, he knows a lot more about it than I do, the Treasury is now out negotiating with the other countries in the Trans-Pacific Partnership, the other 11 countries, negotiate Trans-Pacific Partnership, a separate standalone agreement to create a new consultative body on macroeconomic and exchange rate issues. And as I understand it, they're now quite close to finalizing that. They want to be in a position to announce its creation at the same time that the Trans-Pacific Partnership itself is agreed. There's a ministerial going on in Atlanta as we speak, trying to bring that to conclusion. That'll happen soon, if not at this meeting. The point being, there will be a new international consultative group working on the currency as well as broader macro issues in the context of the Trans-Pacific Partnership. So it's separate from the TPP itself. There are no binding obligations, no legally enforceable disciplines in it, but it is a step in the direction of linking currency and trade, which, depending on how administrations in future days use it, will or will not be a potentially big new deal in terms of U.S. currency policy. In that context, and this is really the final point, another basic distinction was recognized and, interestingly, honored by our Congress. All of us economists say that there is a total distinction between currency manipulation, i.e. intervention in the currency markets to artificially keep your currency weak, as opposed to the impact of monetary policy, notably quantitative easing or QE. The reason that's very important is because when the U.S. says that we want to deal with currency internationally, and have even international agreements, trade agreements that will discipline currency manipulation, some other countries say, well, but you Americans are doing just as much manipulation as we are through your QE, because that does drive down the value of your currency, as it did in 2009, 2010, after the initial application of QE by the Fed, when the other major economies, Europe and Japan, were not yet doing it. So we economists say, no, those are two different things. I could explain that in detail, but don't have time to do so. But other countries say, no, it's all the same thing. The Congress, very interestingly, fully accepted that distinction. In fact, one reason they didn't go after the macro imbalances, because they didn't want to expose the U.S. to attack from others on manipulation grounds via QE, and so they stuck rather uniformly to this intellectual distinction, which I think is right, and which also ought to inform international policy going forward in the future. So, some of the congressional debate is still not completed. There's one bill that's still pending in a conference committee waiting to pass. If it passes, as it looks like it will give new marching orders to the Treasury for how it's supposed to carry out U.S. currency policy. It'll get away from the idea of designating countries as manipulators. It will talk about enhanced engagement with countries who meet certain criteria, which Joe and I recommended, having to do with running surpluses and intervening and raising your reserves, as Joe described. And all that will put more pressure on the Treasury to take a more activist currency view in the future, but again, particularly against currency manipulation. So, final question. Is it time for a Plaza 2? Well, as I suggested, we may be moving toward imbalances that will be, again, considerably larger than those at the Plaza. There is therefore a case for having that kind of policy in mind, but given the confluence between the U.S. doing well and the others doing poorly, a cooperative Plaza-type agreement is not likely to be on. Therefore, given these congressional pressures, I think U.S. currency policy will continue to be country-specific. China one year, Korea the next. Korea probably right now, most in the crosshairs. But I think there's one final conclusion that I like to leave with you, and this is partly my answer to Jeff Frankel, who's concerned about all this morning. All this congressional pressure, again, the domestic unsustainability, all this congressional pressure, I think has already had a huge, if subtle, effect on the other countries, because they've seen it happening. They see that there's actually one very important sanction in the new legislation that's likely to pass, which says the U.S. has to take into account whether a country is manipulating in considering whether to do a new trade agreement with them. So if Korea wants to get into the Trans-Pacific Partnership, now the administration is under a mandate from the Congress to take into account whether Korea is manipulating its currency. And if China, at a next stage, wants to get into the TPP, which it very well might, the administration is going to have to take into account whether it's manipulating its currency. So the trade-currency linkage will, in fact, come into play. None of this is mandatory on the Treasury, but a lot of pressure is there. Given that, I think one of the reasons why Joe's chart showed a significant decline in intervention in the last few years is the recognition around the world of this congressional pressure. We know that China let its exchange rate go up modestly in 2005, again in 2010, because the congressional heat was about to burn and lead to action against it. They had to respond by letting the currency go up. It was their equivalent of the Plaza Agreement, but they did it unilaterally, with the U.S. pushing in an indirect way, and a lot with the congressional pressure playing the bad cop to the administration's good cop. The amount of intervention has dropped substantially. The Chinese undervaluation has dropped substantially, and their current account surplus has come way down. So I would submit, though it's yet to be proven, that the enormous amount of debate, congressional heat, pressure, has already led to some substantial behavioral changes that are likely to lessen the manipulation problem. But at the same time, as I say, the macro problem is on the rise. Not yet to a point where we can have a Plaza 2, but we should be thinking about it, should be getting ready for it, and in the meanwhile, we should be reflecting on what we do learn from the Plaza, and that's why this conference was so important. Thanks again.
Okay, thank you. So thank you, Russell, for inviting me and organizing. It's been great. It's just been hearing David and Charles and Makoto talk about what it was like, and of course, Secretary Baker at the beginning. I was particularly struck how much he referred to Paul Volcker in his opening remarks as a key figure in this whole apparatus. And in fact, I named my paper after a proposal that Paul's recently had, and that is we have somehow been struggling in the world economy without a rules-based, cooperatively managed international monetary system, and maybe that's one of the problems that we're facing. So what I want to do is look back at the Plaza Accord period, take a few lessons from it, and then come to a proposal, if you like, which is along the lines of the title of my paper, my presentation. I actually think you can learn a lot from events like the Plaza Accord, the Louvre Accord, and other events. Some I've been involved in myself. You can be critical of them. I think ultimately this aspect of cooperation or coordination is quite positive for many reasons. Some Charles referred to as the sort of the spillover effects on other things to discuss. The Secretary mentioned that as well. I think the Plaza Accord, in a sense, occurred at a time, I think this is because it's a sort of a fact, which makes you wonder. It occurred right at the beginning. I won't say it ushered in, but it occurred at the beginning of a long period of stability in the global economy. The U.S. economy, certainly. Sometimes economists call this period the Great Moderation. Mervyn King, who's governor of the Bank of England, calls it NICE, for non-inflationary, consistently expansionary. And it really lasted. It was, if you mark where it began, it was almost the same time as the Plaza Agreement, Plaza Accord, and it continued, I think, until recently. And so it's that observation that leads me to believe that some of the turbulence we're seeing globally, I'm going to talk about that for a minute, may be resolved by some kind of a return to some cooperative agreement of some kind. And the word Plaza 2 doesn't ring quite right for me, because I think it's like a Plaza Infinity or something. It's something that's continual. It's more like the rules that Joe's referring to. So let me discuss that. I have a problem moving this ahead. Let's see. There's two lessons I have from looking back at this period. One is that, and I'll emphasize the word sterilized exchange market interventions, I'll call it largely ineffective. There's a very, I think, important book just published by Michael Bordeaux, Noah Humpage, and Anna Schwartz, passed away. And they look at all the interventions of the dollar against the yen and the mark during the period of the Plaza through the Louvre. And they conclude that it's basically no effect. And what I mean by sterilized is, if you intervene in the exchange market, you're undoing that in the domestic market. Or in order to keep the interest rate constant, if you're going to increase the monetary base by buying yen, you're going to have to reduce the monetary base in the bond market. And so that's what we mean by sterilized. Sometimes it's described as the interest rate is constant when you're doing it. So that's what I'm talking about. I think, I'll have to look at Joe's paper in more detail, but it seems to me a lot of those interventions are really not sterilized. They're changes in the monetary base, and of course those affect exchange rates. Any model tells you that. It's not a surprise. Anyway, I think that's what you learn from this period by looking carefully at the interventions. Now, I want to emphasize, I've been in this business myself. If you intervene and buy a currency, you can move the exchange rate. I mean, just like any, if you're managing a hedge fund or a portfolio mutual fund, and you go in and sell or buy a fairly large fraction of whatever stock you're going to move that currency. In fact, it's a strategy sometimes how you get in and out without lots of movement. Of course you can do it, but there's fundamentals ultimately take over, and that's really what we're talking about here. While I was undersecretary, Mark, my able colleague, wanted to look very carefully at each of the Japanese interventions during this period. It wasn't an iPhone, it was a BlackBerry, and my counterpart in Japan would email me every intervention, and I could see what happened to the exchange. They moved frequently. Sometimes they moved in the wrong direction, but they moved. So we're not saying that they don't have an impact, but they don't have a sustained impact. And it's very hard to look at the after effects because there's no event. You're going to move the rate and eventually something will dwindle. You don't see an event at these other times. So that's what I get from looking at this. It's really not reliable enough to have a sustained effect. And I'm emphasizing sterilized interventions. I have a quote here from Alan Greenspan back in the 2000 FOMC meeting. There is no evidence, nor does anyone here in the FOMC believe that there's any evidence to confirm that sterilized intervention does anything. And this last bullet is simply quoting from myself about how there can be temporary effects, but they're really hard to predict, and I don't think useful and effective in any substantial period of time. The second lesson I get from this period, and by the way, that first lesson is not just from the period, it's, I think, a more general finding. Second lesson is, I think, very important and actually quite interesting itself. And the idea is that some of the participants in this agreement had their domestic monetary policy move almost as part of the agreement, and others didn't. Okay, so I say for some participants, certainly the U.S., monetary policy strategy wasn't affected at all. And if you look at the Plaza, if you ask Paul Volcker, who was chair of the Fed, he will say this. The Accord simply confirmed that the overall strategy of those central banks not affected would continue. In fact, there's statements. I'll show you some statements in a few minutes. But for others, and I think Japan is the clear one, based on not my research, but other people's research, where there was an effect. We debated that to some extent today with Makoto and Taka. But this chart is actually from the IMF. It's sort of replicated from an IMF study. And it looks at the interest rate in Japan during the period of the Plaza Accord through the Louvre Accord, which are marked on the chart. The blue rate is the actual policy rate of the Bank of Japan, the call money rate. The red line is something called the Taylor rule. It's estimated by the IMF, so I have no responsibility for it. But it tells you a very interesting story. I think it's pretty important. There's other ways to do this, but this one's pretty good. If you look at the period from the Plaza up through the Louvre, the interest rate in Japan is too high relative to what macroeconomic considerations would tell you. Too high relative to the inflation rate, too high relative to GDP. And indeed, I think as Taka may have referred to earlier, there was a big increase in the interest rate at the beginning of the Louvre. So they really went in the wrong direction at the start. So that's an excessive tightening of policy. The rationale's pretty clear. If you want to get if the monetary policy is going to participate in a non-sterilized way in this agreement, it's going to somehow want to make the yen stronger and the dollar weaker, make the dollar weaker. That was the purpose. We've heard that today, and that'll do it. That's really making the yen more attractive. And through this whole period, it's the same, above what would it be if you just looked at macroeconomic conditions. Amazingly, it switches completely at the Louvre. It goes the other direction. And in fact, this is the period where people would say, hey, the monetary policy is now too easy, and it's quite really low compared to what macro conditions would suggest. And of course, that's the beginning of the excesses in the bubble that Makoto talked about today. There's an impact in Japan. That's what at least this analysis shows. And so I think that's a lesson. You could argue whether it's a good or a bad impact. I think it's a bad impact because it basically got policy off track and then maybe added to the bubble early on with those low interest rates. But it's certainly there. Now, what is interesting to me, it's not just this correlation in the data, but it's actually in the Accord, if you look at it. I call it smoking gun evidence, but whatever it is, it's in the communique. So the government of Japan committed this is the Plaza Accord, flexible management of monetary policy with due attention to the yen rate. And you saw what they did. They raised interest rates. Don't know the details of how that agreement within Japan was made, but it's clearly in the statement. Similarly, in the Louvre Accord, it says, a quote from it, the Bank of Japan announced that it will reduce its discount rate by 0.5% on February 23rd. That's basically trying to prevent this continuing appreciation of the yen. And so even you look at this idea on the charts, deviations from rules-based policy, it seems to me they're pretty clearly related to this accord. And you got, again, statements in the accord plus actually what actually happened. Now, in contrast, that's not what happened for the Fed. If you look at, in fact, this is a quote from Paul Volcker. I don't know, I didn't say this today, but he said it in one of his memories of the event. Why did he participate in the Plaza Accord? He didn't have any implications for the Fed. He participated because, and this is a quote from Paul Volcker, in fact, it was the absence of any need or desire to tighten policy that provided a green light for the Plaza Agreement. So he was pretty clear that it was not going to affect U.S. monetary policy. And then I have a couple quotes about what they say about the Fed in both the Plaza and the Louvre communiques. And they're really just continue what we're doing. We're going to provide financial environment conducive to sustainable growth and continued progress toward price stability. No indication they're doing anything differently. And the same thing as the Louvre. Monetary policy will be consistent with an economic expansion at a sustainable non-inflationary pace. No sense of there's anything related to the exchange rate. But of course, Paul Volcker, a lot of other people else knowing that they were in a mode to reverse the tightening that they began in the early 80s, where the dollar appreciated so much, and that was going to be undone as they eased. So it's just a natural ebb and flow of that disinflationary effort. So that's what I think happened. And the message to me is, there's really nothing wrong with this kind of cooperation if you're not implicitly getting domestic monetary policy off track, or if you're trying to fool yourself that sterilized intervention is going to matter. So that's the lesson I come away from this. Now, the other thing which I mentioned at the beginning is this is the beginning of a period of quite striking stability globally. Again, the word nice, global stabilization, great moderation. And I think it began about this time, as I mentioned, Mervyn King calls it the nice period. And it had a sense in which I think it was not just good domestic policy, or it wasn't good domestic performance in the US and Europe, and there's more questions about Japan, of course, but it seemed like a pretty good international system. Not a lot of complaining about spillovers. Of course, there was impacts of the disinflation on emerging markets, but especially when emerging markets started to follow these more rules-based policies, things seemed to work better. And what I notice is that more recently, some of our problems have to do with the spread or amplification of deviations from these policies, which is causing turbulence and one of the drivers of our current instabilities. So what I want to argue, first I want to try to prove or just convince you that the second bullet is correct, and I'll be saying things somewhat contrary to what you heard a few minutes ago. but also that if the argument is if you kind of go back to the policies that followed the Plaza Accord for roughly 20 years, if you go back to that kind of policy, things will be much better. So you have sort of the empirical observation plus a few facts and theories to go with that. Okay, so let me go through pretty rapidly some facts to help with this. I have like 5 bullets here of facts, because I think there's lots of disagreement. You can see it at this conference, but you got to study it empirically. So first of all, we have models that show there are spillover effects of policy deviations. I'll call them deviations from policy rules, more interventions kinds of policies. And here's one example. This is from the IMF. This goes to some of the points about the impact of overly easy policy in the U.S. abroad. This is just the impact of a cut in the U.S. interest rate compared to a policy rule on other countries. There's huge negative effects for emerging market countries. And so there are countervailing things. If you have an easier monetary policy in the U.S., that's going to make the exchange rate appreciate abroad. That's negative demand side. But you also have the U.S. expanding, okay? It's a countervailing effect. Well, it turns out in these models, it's the exchange rate that matters the most. This was the IMF's main model that I'm simulating here. So that's kind of a negative spillover. I call it a negative spillover of a policy deviation, of a deviation from normal kind of policy. Second bullet, there's an amazing amount of, well, I'll call it policy contagion going on, where central banks tend to follow each other. And if interest rate is extra low in one country, it'll be extra low in another country. There's many reasons for this. It shows up in regressions. It shows up when you ask central bankers. They will say our interest rate is lower than normal because the Fed or the ECB's interest rate is lower than normal. And there's also a multiplier effect of this, because if central banks are following each other down or up, it'll multiply. It's basically a factor you can show with a graph like this. So this is kind of a busy graph, but you have, say, the interest rate for the U.S. on the vertical axis, interest rate for the rest of the world on the horizontal axis, or one particular country. Both central banks are to some extent reacting to each other. So the foreign central bank will have its interest rate somewhat lower if the U.S. does, and the U.S. will do the same. And in this case, you have an initial cut in interest rate, say, of 1%. Because of the interaction through the global financial system, it's going to multiply. And in this particular example, it multiplies by a factor of 2. It depends on how reactive the central banks are. But this is the sense in which deviations from policy can multiply and have global effects, I think to some extent like we have been seeing in recent years. The third point relates to unconventional monetary policy. And there's a lot of disagreement about this, but let me just show you some figures. I think that in effect, the spread of unconventional monetary policy is very much like a currency war. I don't like the term a lot, but I don't see any other way to describe it. And I just gave you some charts to show you this, or at least the way I think about it. This is the yen-dollar exchange rate, going back to 2008, it looks like. And you see the huge appreciation of the yen. That's during the period of quantitative easing of the U.S. You could see where it was right before the financial crisis, about 120 or so. And it's just down, down, down. And that's during the period of U.S. quantitative easing. So it's basically an effect on the yen. We can't prove it's all that, but the timing is certainly amazing. In Japan, there's an election, and one of the candidates says this high yen is a problem. We got to have a new policy. And that's Abe. He wins the election, and the first thing he does, he appoints Haruhiko Kuroda and says, you do what the U.S. is doing because this currency is too strong. He does. They do quantitative easing. Japan does quantitative easing, and you can see the currency going just as they want it. So from 80 to 120. So that, to me, is like a currency war. Now, the central bank doesn't think of it that way necessarily, because they're thinking about domestic expansion, but the ultimate effect is just that, and it's this multiplying effect. Actually, the story continues. This is the euro dollar exchange rate. And I'm marking August of last year. That's the time of the annual Jackson Hole meeting that takes place. Mario Draghi runs the European Central Bank, and he basically says, hey, what about us? Not the exact words, but our currency is really strong now, especially with what Japan has done. So he's going to do quantitative easing too in a big way, and talks about it and does it, and there you have the large depreciation of the euro, and of course that's, again, another element of dollar strength that we've discussed today. And then to some extent, this is affecting the rest of the world, because almost at the same time, August 2014, you have almost every currency in the world, except for the Chinese currency, since it's so closely moving with the US dollar, depreciate. And this is that picture of that. And it's really quite large. I'll show you some charts comparatively in a few minutes ago, but that's sort of that same, I think, phenomenon, this contagion. And some of this is quantitative easing type of actions, but largely this is just the market moving to the fact that the euro and the yen have not appreciated against the dollar. I think the move that occurred this summer in China, early August move, it was a 2% appreciation in one day, 1% the next day. They saw market turbulence and basically let it alone. So the currency has not moved since then. But it was an attempt, I believe, originally to say, hey, the whole world is depreciating against the dollar. We're stuck up there with the dollar. We got to do something about it. I think that's basically what was in their mind. But they saw a lot of turbulence. They heard complaints, and so they've held off for a while. Don't know for sure, but I think that's what happened. But anyway, that's the third point. The fourth bullet is what I would think is these deviations from policy detract from economic performance in various ways. They lead to other kinds of policies. I don't know if I have a picture of this, because I just have examples. When a central bank is in a situation where, say, the low interest rate in the US is appreciating its currency, it's got some choices to make. It could have a lower interest rate, as we've shown here, but that's also maybe counter to domestic purposes. If they don't want to lower the interest rate further, what do? Capital controls. Let's keep those capital flows from coming in, because they're going to go out, as they did go out, actually. So the capital controls, I don't think capital controls are a good thing to do if you can avoid it. And there's these macroprudential policies. There's no reason not to have strong policies that have good capital ratios and liquidity ratios. But the kind that move back and forth is a substitute for monetary policy, or because of the impact of monetary policy abroad, I think they're not a good idea. So all these things to me, and mentioned currency intervention is another one, with a lot of problems with that, are really the ramifications of this, which I think add to global instability and worry me quite a bit. So the last one is my attempt to see whether there's actually an increase in global economic stability as a result of this, all this unusual kinds of action. Again, deviating from rules, unconventional policy that tends to spread. And again, the motivations, I'm not questioning the motivations, I'm questioning the effects. This is one example. This actually comes directly from Agustin Carstens, governor of the Central Bank of Mexico, who, like many emerging market country leaders, are concerned about this. This is just the volatility of capital flows in a paper he recently gave at Stanford. I think it's a version of a paper he gave at the Peterson Institute recently as well. And you can see there's this increase in capital flow volatility during this period, much less than it was earlier. So this is the kind of thing we do have an increase in capital flow volatility, and it's more than current accounts. It's actually capital account movements. Some people think it's an inherent nature of the world economy right now. I think it has to do with this change in policy, at least to some extent. And then this chart is just the percentage change in the dollar against major currencies. And so now I'm going back to the Plaza Louva period. And it's just, this is annual changes. And maybe this is not major, but it seems to me it's pretty significant. you had a smaller volatility of exchange rates in the, I'll call it the post-Plaza Louva period compared to recently, say compared to a period where I think the policy began to get off track, 2003. Just measure the standard deviation, it's quite a bit higher, 8.2. You could say, oh, the financial crisis, which is a big peak there in volatility, it's just the financial crisis. But look where we are now. It's the highest percentage change in this whole period over the last 12 months. So there's something going on here. Whether it's these deviations from policy, I think it is, but I think more work needs to be done. And you can see disagreement about it, so it's very important. So what all this leads me to think about is this: is there something we can do about it? So I have this proposal. In a way, it's kind of a modified Plaza. It would simply be that each country, let's focus on central banks, would report and actually commit to a particular monetary policy strategy. It's not too dissimilar from what Paul Volcker entered into those Plaza and Louva agreements. The Fed, he must have agreed to it if it's there. But it's a little more detailed because now we have this notion of an inflation target. We now have some sense of what the equilibrium real interest rate is, or we at least can talk about it. We have some sense of what kind of a good reaction function would be. So you could actually put out a strategy for each central bank. And what the lessons from Plaza to me is these strategies should be what's best for each country. And if it is, it's going to work pretty well globally. It's almost like each country choosing their own monetary policy based on their own domestic considerations will generate a good policy globally. Actually, there's a theorem that shows that, plus I think we have evidence for it. And it would also be, not going to use sterilized intervention. There's a question about how you increase or decrease the monetary base, whether it's all domestic assets or foreign assets. That's an issue. It could be part of the agreement one way or the other. Obviously, today you need more than the G5 to make this happen. I've been in many G20 meetings. I know what people mean by they're kind of unwieldy. But you really need more than that. In fact, it'd be good to have the IMF involved. I actually think that you maybe want to think about whole IMF articles here. When the IMF was put together, it was two countries put it together, the US and the UK, 4 or 5 years of talking about it before it actually was voted on in the US Congress. David Papel reminded me it's not just two countries, two people, two persons in doing this, but they got it and they gathered 44 countries to agree to it. And it was more than a fixed exchange rate idea. In fact, a lot of it was the purpose was to get rid of all those controls on current changes. And the original idea is it took 3 years or 5 years, and each country that agreed to this agreement had to remove all the restrictions on current transactions. They allowed capital controls at that point. It was also, not so much it was like to me, adjustable peg if you read what they were doing. It was to avoid competitive devaluations, I think, not so much to avoid devaluations per se. There was a lot in there about you could change your exchange rate by 10% with no consultation, effectively. So, in fact, there's an interesting. Of course, the IMF agreements had to be passed by the U.S. Congress. It wasn't just the 44 countries agreeing. So you have an amazingly interesting testimony of Secretary Morgenthau and Dean Acheson as Assistant Secretary of State, and of course White at the Treasury. And they're being grilled a lot by largely Republican senators at that point. There's one place where Senator Taft starts asking, I think it's Acheson at this point, about what about these devaluations or depreciations you're allowing? He says, we're not trying to prevent depreciations. We're trying to prevent competitive depreciations, very explicitly. And so it seems to me that the notion of that agreement was important, not so much because of what we call the Bretton Woods world of fixed exchange rate. It was really to prevent these competitive devaluations, and also to remove a lot of the restrictions on current account transactions, and ultimately to remove the capital ones as well. So I think in a sense you could think of this as something grander than a Plaza Accord with a few people, but it would have to be started by a few countries getting together, probably people talking about it in detail, meetings like this and others. But I think it's promising, and it tells you a way forward to, I think, create more stability, eliminate a lot of these excesses that I'm pointing to now. Perhaps the best aspect of this is what I put in italics at the bottom. The key feature of this, and I'll read it, each country could choose its own independent strategy. It's pretty good for an international agreement. At the same time, avoid interfering with the principles of free and open markets and contribute to this common good of global stability and growth. And in a way, that's what Volcker was searching for when he said, we got a problem without a rules-based system at this point. This is not the be-all and end-all, but it seems to me it's going in the direction of an improvement in the system based on lessons learned from the Plaza. Thank you.
How much? Okay. Thank you. Thank you. Should turn it open to questions, but Russell told me I could ask a question or two first. So just to say three quick things. Charles spoke about spillovers. So whatever you think about macroeconomic coordination, there's been debate today. There is bringing people together does has ramifications. There's a lot of cohesion, especially in the 5 and the 7, but even in the 20, for tackling other issues outside the system. I think it's a very important point when you're talking about dealing with debt crises, et cetera. Fred talked a lot about domestic politics and how that weighs in on currency issues. Others did as well. I just want to say that is really true, and I thought he gave a good outline of what's been going on lately. John, I'm not sure you would like a rewrite of the articles if, given where the rest of the world is on capital flow measures and whatnot.
This is interrupt. I mean, the IMF now calls it capital flow management. I mean, it's such a euphemism for get in there and control capital.
Yeah. But anyway, just there were like a few thoughts just struck me just to throw it out to the panel. First, you know, I think if you're going to have views about exchange rate and current account levels, constellations, it does imply you need a view about probably about macro policies and the balance and the mix. And so I guess we've been debating this all day today, but what role should external objectives play in the stance of domestic policies? And is it realistic to think that, for example, a monetary policy authority would orient monetary policy to some degree to achieving a given constellation of exchange rates or current account? I throw that as a big question. And then do you think authorities could agree on the right constellation, shall we say, of exchange rates and current accounts, or the policies to get there? And then, you know, one of the things is, I mean, exchange rates can cause current account, but so can the policy mix. So you can imagine a country that's very big and has a whopping surplus and doesn't have an exchange rate in this day and age. And the real issue is not the exchange rate, it's what do you think is the right mix, and people may debate that. I won't mention any countries' names. And just to throw it out to Agnes, I read your article. You know, what I was thinking as I read your article is that if you asked current U.S. policymakers what their view about the dollar's reserve role is, that they would basically say, well, the U.S. didn't ordain the dollar's role. It happened organically. It reflects the large economy, deep capital markets, respect for property rights, et cetera. And our job is to maintain a sound U.S. economy. If others want to open up their economies and do the right things, and it would be totally understandable that capital would flow to those places, and that there would be increased multipolarity, and this can all help happen in a healthier global economy. And if the world is a better place, then the U.S. is a better place. that is fine with us. There might even be some who would say that the dollar's role does limit exchange risk for U.S. agents, but on the other hand, it constrains us in the nth-1 currency sense that was mentioned earlier. And we don't really want to be the global importer of first and last resort. So some of us might say, well, you know, if the privilege is so extraordinary, why doesn't anybody else want it? And so I'd like to know just how, you know, you react to that, what I would call kind of a broadly standard U.S. view. So I just throw those questions out for anybody to answer anything they want just to get them going. And Fred has already volunteered.
Well, actually, I want to ask John a question. The name Beryl Sprinkle has been mentioned a few times today. He was the undersecretary who replaced me and preceded David. And his doctrine determined the policies of the first Reagan administration. And to put it in one sentence, it said, if every country does the right thing domestically, the international system will be okay. Well, in fact, of course, the international system blew up, and that's why they had to do the Plaza. John, how is what you propose any different from what Beryl Sprinkle implemented for 4 years in the early 80s? It sounds to me like it's the same thing.
Well, I think, first of all, Beryl was in the middle of the disinflation itself, right? It was a period where the Fed was tightening that Paul Volcker had to do. It was a heroic thing to do that, to get the inflation rate down. And by the time the Plaza Accord came, he was starting to ease. So it sort of fit in quite well. And I think, as Paul indicated, the Plaza Accord didn't really have any impact on that. And so there wasn't an impact on monetary policy, unlike in the case of Japan. So Beryl's view was actually kind of a Milton Friedman view. He's from Chicago PhD. It's very consistent. I've written about this a lot. It seems to me, if you're in that kind of position, you can't rule out intervention completely. You have to be, it's a mistake to say you're never going to intervene. I think it's not credible completely, so I've argued you don't rule it out. You try to avoid it, try to avoid verbal intervention as well. I think that's a good model, especially when the sterilized stuff doesn't work. And I don't know exactly what Beryl said about if every country does it's fine, it'll be good, but I think the experience of the post-Plaza Louvre Accord is quite consistent with the notion that the U.S. doing just what Volcker wanted to do and Greenspan for the most part until recently. You had pretty disciplined policy, good policy focused on a few goals in the UK. That's where they started their inflation targeting, and Europe for the most part. I mentioned there's some problems in Japan. Then you began to see the emerging markets by 2000 joining in with some kind of an inflation target mode, all different, but all sort of rules-based, and it was working pretty well. Not perfect, but pretty close to a situation where there was not a lot of complaints about spillovers. It was not a lot of complaints about the kind of things we're hearing recently. And it wasn't until we moved away from that world that we're hearing all the complaints. So it seems to me, you can characterize Beryl Sprinkle in any way you want, but the notion is we had a good 20 years, which is pretty close to a world which appeared to be cooperatively working. Not perfect, and it took the emerging markets took a while to come in, and you did have the impact of Volcker's high interest rate on emerging markets, and you had to deal with a lot of those questions. But, geez, it seems to me it's doing a lot better than where we have been recently.
So basically, what you don't like now is all the QE.
Yeah, well, the zero rates forever. I'll add that to my list. And the notion that we have no idea what that bank is going to do right now, and the debate about it, I mean, that is not good. There's so much uncertainty. So I could go on about this, but again, people are well-intentioned, but I think we need to get back to I would call a more rules-based system. Just what Paul Volcker said. He may have a different way to do this than what I'm suggesting, but it adds predictability. It adds more certainty. The markets have some sense of what's going on.
there's much less need for every member of the FOMC to go out and talk about it each time. You have fewer worries about these competitive devaluations, and I understand they're motivated by domestic purposes, but they're there. So anyway, I think there's evidence, theory and evidence.
Others?
So the standard US view, which is quite benign, yes, there are benefits and costs of running an international currency. Perhaps when the interest rate goes up because there is a competitor to the dollar, it will be less benign, but at the same time there is a great responsibility. There are papers showing that there is an insurer, the US is an insurer, making a big loss in case of a global crisis and making some benefits in tranquil times. So this is why the other countries maybe so for the euro area is not willing to run an international currency. If it happens, fine, but they don't mind. And I think the strategy of China is quite dangerous. The idea of using the internationalization of the renminbi as a way to impose internal reforms, I think it's very dangerous. We played this game in Europe and we failed. So I would not be very optimistic.
Okay. One point on, Mark, your question about a country without an exchange rate that might have a large current account imbalance. I understand the frustration. You didn't want to say, I am guessing you mean Germany. So as an economist, I would say, well, they have a real exchange rate. That's the ratio of prices in Germany to the prices around in their trading partners, and it's too low. But there isn't a nominal exchange rate between them, as you say, because they all use the euro. So it is a function of the dysfunction of the euro area that this has to play out. And I think, unfortunately, it seems to me that everything countries do affects other countries. And that's just always going to be true. So I have some sympathy with John's proposal, actually, that we should talk about what we're doing and tell each other as much as we can in advance and make sure that what we're doing is stabilizing. And that I can fully agree with. But I do think that there is a distinction between actions that involve operating in other countries' markets, buying other countries' assets, versus actions that stay within borders. Now, even if your policy stays within the border, it's true it affects other countries through second indirect effects. And we care about that too, but it seems to me that when you do a direct action that directly hurts another country, that's really a higher step up, in which a case it says to me that the grounds for international rules are much stronger. But I don't rule out rules even in the other case, where even when you stay within your borders and do QE, that does have effects, and maybe we should have some kind of rules of the game too.
Is Jeff Frankel still with us? Okay. Mr. Mulford. I don't know what
okay.
to call
Well, I'd have a question, but first I just want to comment on Burl Sprinkle. When I got to the Treasury, the impression I had was that he was saying to everybody else, see how we're doing things. If you do things like us, then we'll talk to you.
So could you say that again? I'm
He
sorry.
said, we're doing a lot of things right. When you get around to doing things like we're doing them, we'll talk with you.
Doesn't seem
That
too
was
helpful.
how it came over to me. But I have a question about this rules-based discussion, and that is, if it is a good idea, who do you visualize as the people who get together and set the rules? I mean, as between central bankers on the one hand, finance ministers on the other, academic contributors, and so on. How do you get a consensus agreement on what the rules are in today's world?
Well, I think right now we're kind of we're still in this unconventional period, so we're not there. But again, for most of the 80s and 90s until recently, there was a fairly well understood way to react, and people have, we heard a lot about these rules today. And
Not a formal definition, eh?
no, it wasn't. No, it wasn't formal. I mean, Greenspan used to say it was about 80% of what we do is described by one of these rules. So there's different ways to do it. I mean, I like to use the word strategy, and I quote some of the quotes from the Plaza and the Louvre are kind of a strategy the Fed wanted to put in there. I think we know enough to have more detail than was there then, but I would hesitate to have things that where you're making or persuading or in negotiation one country to go against its own domestic interests here on monetary policy. In terms of how this kind of thing would work, I mean, there's many ways. I mean, I was mentioning before, you guys are in the Treasury before this plot, so you're talking to your colleagues, you're thinking about what to do yourself. You maybe have some people on the phone, you have your market experience, and so you're forming this apparatus in an informal way at the beginning. That's how the IMF was created originally. That kind of took, they started in 1941. With Keynes talking about during the outcome of the Lend-Lease discussions. The vote was in 44 of the members, 1944, 44 agreed, and the Congress approved it in 45. So that's a long time with a lot of discussion and a time, in this case, it's largely the United States. I mean, the British were involved, but it was driven by the United States, and it was, I think, an incredible show of U.S. leadership at the time to get this to happen. Almost all economists loved it. The conservative Chicago economists, Frank Knight, so one of the originators of policy rules, was for it. And Jacob Viner, distinguished international economist, wrote an extraordinarily good piece supporting it. So it was 90% of economists were for it, pretty unusual. So we're not there yet for what I'm talking about, that's for sure, but you'd have to work at it. So that's the kind of thing I'm thinking about.
So maybe we should collect a few questions and then deal with them. I've seen 5 hands go up. First, second, third, fourth, fifth, and maybe we'll close it off at that.
So my question actually is regarding the euro, and it's really concerning the stability of euro. And my comments sort of stem from what Martin Armstrong has been saying for a while, and he was the guy who's been consulted by Helmut Kohl when the euro was being formed. So if you look back in currency history, when the East and West Germany were combined, all the debt was combined before the Deutsche Mark was issued for the new full Germany. Also, when the 13 states of the United States came together for a common currency, all their debt until that point was pooled as a common debt. And then everything became individual states. But until that point, it became a common debt. While now what we are seeing is when we have these stress events in the financial markets, everybody rushes to the German bonds. And I know I buy them because it's the safest bond. I don't care about the French or the Italian, but they have to pay a higher premium. So that's going to put a greater stress. And we can talk about these long events, years and years, but the markets can stay irrational far longer than somebody can stay solvent. So that's the first issue I have a concern with the euro. The second is the whole idea of productivity. Germany and Scandinavian countries are far more productive than the southern countries or Mediterranean countries. So that intrinsically or culturally is driving euro in two parts. We can have North Europe and South Europe, which is also putting a lot of stress in euro. So I think you had mentioned in your talk that we have a 10-year window for the euro to figure out where it's going. So what is your view or the panel's view, given these inherent stresses with the very way euro was born to what we are seeing today? How do we see this unfolding in the mid future?
Okay, Tucker, go ahead.
So The big instability in the past 20 years. One is in Japan, the bubble burst, and another one is Great Recession or the Lehman Brothers kind of things in the U.S. You were sort of implying that if the interest rate was high enough in the 1986 to 89 in Japan, like 8%, that would have prevented those instability. Now, if the interest rate was, and you're not the first one to say that. I think there was a discussion in Jackson Hole way back, and I think the Yamaguchi who said, "Well, you're suggesting 8% interest rate in 1988. It would have been impossible." Now, impossible domestically, but also from macroeconomic point of view, it would have sent the Japanese economy into deflation because the CPI was almost zero, and in 1986. And allowing the appreciation and raising interest rate would put into the deflation. That would violate inflation targeting of 2%. So your proposal sounds like, using interest rate for 3 purposes or 4 purposes, the CPI and output and financial stability. And frankly, I think the macroprudential policies like credit control and so on would be prudent policy in the second half of 1980s in Japan, and also in 2004 to 2007 in the U.S. I was very surprised to hear that you are negative on macroprudential policy. And without macroprudential policy and let interest rate to adjust on the rule and to prevent everything doesn't sound to be possible macroeconomic management. Another question to Fred is the Congress finally got it, the difference between the currency wars and of manipulation and the QE is very welcome, and I'm very glad to hear that. But does this interpretation continue to the next Congress and next Congress? How the wording would prevent that reinterpretation of what manipulation constitutes?
I have a quick question for John. There's been a lot of discussion today about the importance of the U.S. leading, going not just for the Plaza, but now back to Bretton Woods, up till now. And in other contexts, you've advocated policy rule legislation for the U.S. And my question is, suppose instead of doing everything on your last slide, which seems incredibly ambitious in terms of coordinating in G20s and getting other countries to, what would happen, something maybe a little less incredibly ambitious, which is if the US adopted policy legislation leading by example, do you think that other countries would follow, and do you think you could get close to this much bigger type of solution by doing that?
Okay, go ahead, Mr. Truman, but quickly.
So actually, I'm not going to make a question, I'm going to make a comment. Since this is a conference about the Plaza, let me say that the lines in the communiques in both the Plaza and the Louvre about central bank policies were obviously written by the central bankers. They were designed, I don't want to offend our host, to keep James A. Baker III's hands-off monetary policy. He had pretty strong views on that. In the case of the Bank of Japan, Bank of Japan monetary policy at that time was run by the MOF. The one interest rate increase actually was by the Bank of Japan, but they don't need to. It was the kind of interest rate increase that they didn't have to get the MOF's permission for. And the Bank of Italy and were the same, and the Bank of France and the Bank of Italy were in the same, and the UK for the same purposes. But basically, it was a compact among the central banks, other than the Bank of Japan, to say we're not going to have anything to do with all this. So now I'm not sure whether that cuts in your direction or not. You might, I suspect you're going to say, oh, it cuts in my direction.
Well, you said other than the Bank of Japan. That's the whole point.
Yeah, the Bank of England and the Bank of the Bank of Japan was completely controlled. But in the Bundesbank case, in the Federal Reserve case, the language that's put there was written by the central banks, and was designed to say you want to have something to do with it. A communique that was not issued by the G5 was in January of 1986, in which Volcker and Pearl refused to issue a communique in which they said that they're going to reduce the interest rates. Now, I don't know which way that cuts in your grand world of it, but I think in some sense it puts a different interpretation on what those sentences were and where they came from and why they were there.
Okay, last question quickly.
Thank you for your presentations. This is a brief question about the IMF. My name is Beverly Barrett, and my question is, how would you reform the IMF to bring in emerging markets, particularly China, so that we can make a new world order and a monetary system? And what would you say to the U.S. Congress to reform it? And considering the new Asian Infrastructure Investment Bank and ways like that, China's leading. So what can we do to stay involved here in the U.S.?
Okay, thank you very much. So a bunch of questions. John, do you want to start?
Okay, so so Taka mentioned that the rates would have to be higher to prevent the bubble by these questions, but it's still just two factors in this rule, right? It's not four things, it's just two things: inflation and the state of the economy. So that's what's driving these IMF, and I mean the IMF 2011 charts that I showed you. And to me, it's a bigger question is the period that we're following the Plaza rather than following the Louvre, because that actually is what seemed to dent the Japanese economy and require these excesses later. So it's not just that period, and I doubt the rates would have had gone up as high as 5, or as high as 8, as you say, if the policy had been on track all through the period. On macroprudential, I have no problem with prudential regulations that take the macroeconomy into effect. So generally they've been higher capital ratios or more concerned about liquidity ratios. My concern is the counter-cyclical movements in these instruments. It involves the central bank in politics a lot more than I think our central bank should be doing. It's a real fine-tuning thing. It's very hard. I mean, it's actually, you can see examples where it's been forced on central banks because of the unconventional policy. That's what happened in Switzerland, obviously. They had to use macroprudential for their housing market. And in more extreme cases, Hong Kong and Singapore, the same thing. So you would eliminate a lot of that sort of fine-tuning aspect of it, which is my main concern. So David asked about U.S. leadership and whether it would be sufficient for the U.S. just to do it. I think it would make a big difference if the U.S. just does it. But I do think there's an advantage of having a more participatory set of agreement or something. Remember, this idea is you don't have to deviate from what you're doing anyway, and so you're kind of part and parts, but you're kind of committing too. It's why I say it's not Plaza 2, it's Plaza for longer than that. So you're committing to it, and I think there's some value to that. I think the Plaza. I think Ted's right. I don't know. My guess is the Fed put that line in, and that's that. I mean, how else could it possibly be with Paul Volcker? I don't know about the others, the Bank of France or the Bundesbank. But clearly, the Japanese seem to have some terms in there related to currencies and related to the agreement, and so I think that's the lesson to learn from that. But I think the U.S. is a very influential central bank. The Fed's usually influential, and and central bankers, they talk to each other all the time. And they go to the BIS once a month or whatever it is. And so I think it would be influential. And I think ultimately when the Fed, I think, will go back, can't go back home completely, of course, but there will be a positive impact more globally from that. That's my view. Anybody else? Did I forget?
But John, if you're doing what you would do anyway, as you put it, what's the commitment?
Well, the commitment is to
do what you would do anyway.
First of all, there's a value, as Joe was saying, to laying out what your strategy is for not just markets, but for your these other entities that are highly influenced by you. There's also a value in committing to that, not forever, because the world changes, and I think you probably want to have a system whereby if you change, or certainly if there's a crisis, there's something else you're going to do. But there's a value of committing in some sense, and I mean, that's what the Fed seemed to me to do in the Plaza. They're committed to this non-inflationary growth. I forget the terms I put there, but they stuck with it for a long time. So I think there is a value to that. I could go back and make analogies to the original IMF agreements. Remember, the deal was if a country signed that agreement, 1944. They had to agree to begin to remove the restrictions on current transactions. They had to agree to this adjustable peg. If they agreed to those, then they get the borrowing ability. They get the ability to get, to borrow from the IMF, and the U.S. put up a huge fraction of that initial capital.
But that was then asking people to do something that they weren't planning to do otherwise. Whereas you seem to say,
well, I think it was a way to get them together.
Anyway.
I think it was a way to get it was a recognition that would be a valuable thing to remove current restrictions on. I mean, it was terrible.
I agree with that.
It was terrible. So
capital controls were allowed. Capital controls were allowed.
Absolutely. But ultimately, the idea was to get those off, and I think we're going backwards on that one.
So, Agnes, can you tell us in 2 minutes what is the fate of the euro?
Very easy.
I think that was the question.
No problem. So I agree completely with what you said, that the fact that sovereign debts are national debts introduces a specific instability. In case an increase of the spread is self-fulfilling, and then you have debt unsustainability. And also a recent paper by the Institute in Halle calculated that the fall in the German Bund yield related to the crisis, it's a flight to quality effect, amounted to a saving by the German government by 100 billion euros, which is more than the total amount lent to Greece. So it helps reconsider the so-called transfer union within the euro area. And so the solution is a Hamilton moment to merge all the debts into a sovereign debt, federal debt. Great, this is political union. You need common resource, and you need all the budget be decided at central level. So we are very, very far from that. So we are trying with the ESM, with the European Stability Mechanism, to approach this kind of thing by helping countries that would experience a liquidity crisis or even a sovereign crisis. For the sovereign crisis, we don't have the restructuring mechanism, so we are not very far away. In my view, the ESM should introduce more automaticity to be really efficient, but this is some...
Essentially what you're saying is it has to become a more political union than a monetary union.
You cannot have a federal debt of this size without political union, because then how do you manage the debt? You have to decide on a tax, and so you need an assembly to decide the tax, and you need a finance minister to present the budget.
Essentially becomes the United States of Europe of some sort.
Yeah.
They need more Alexander Hamilton, is what we always say in the United States. Fred, what's the next Congress going to...
May I respond on productivity?
Please.
There are two problems with productivity. The first one is the average productivity in the euro area, so you need growth. at the level of the euro area, but also the dispersion, because debt is national, so debt to GDP is national debt to GDP, which is important, and the spillovers are enormous within the euro area. But it is also the fact that we need to consider whether we want a first best or a second best in terms of growth policy. If we are serious about growth, we should accept the agglomeration of production factor at the center where productivity is higher. So it means moving labor and capital from periphery to the center, but then you need to have transfers going the other way. And so this is the problem with the discussions with Germany, where they accept the agglomeration, but they don't accept the transfer the other side. So, and you need to incentivize countries like Portugal to continue to train the young, to build universities, despite the fact that they will leave. So the other strategy, the second best, is to impose current account equilibrium at the country level. And I think this is much less powerful in terms of growth, but this is maybe, I think it's the strategy we have today.
I didn't get a question from the audience, but John raised a question in my work about intervention sterilized versus unsterilized. And I don't actually split the two up in the data, but if you look at the data, it's almost all sterilized. These countries can't intervene in this giant magnitude and not sterilize, or they'd have runaway inflations, and they don't have it. So Norway is like the cleanest example. Norway's sovereign wealth fund has no effect on its monetary base. They have very low and stable inflation, and yet they have a massive current account surplus because of the sterilized intervention they do. And it's not just because they're an oil exporter, because frankly, not oil exporters have surpluses. Saudi Arabia ran a deficit for most of the 80s and 90s, and Australia has huge oil exports, but it runs a huge deficit. But it doesn't have a sovereign wealth fund that invests as much abroad.
What's the next?
Yeah, but compared to Norway,
what's the next Congress going to do?
Norway is very wise. Why do you want to find Norway?
I think, so you say Norway's wise. Norway's being excessively conservative, and there is an externality on the rest of the world. I absolutely think they should have a sovereign wealth fund, and it should save a large fraction of the net revenues of oil. But they're saving 100% of the net revenues of oil and spending only 4% from the earnings on the past stock of assets, which is very conservative strategy. I mean, they should invest some of it at home, they should consume a bit more of it, and we should have global rules. It does have an externality on the rest of the world.
Taka asked, what about future Congresses? Who can predict the Congress? And it's quite possible that if the dollar went up really dramatically, that whatever the cause, Congress might get excited again, like they did prior to the Plaza. I did a calculation in my paper. If the dollar went up another 20% from where it is now, which is about what it went up over the last year or so, but do that again, it would take the U.S. current account deficit to $2 trillion per year, and that would catch a lot of attention, and it might lead to some demands for a reaction. However, short of something extreme like that, my guess is they will maintain the distinction between the macro cause and the intervention cause. The reason is defensive. As I said, they want to protect the U.S. ability to continue to do QE in future crises, so they don't want to open up the possibility that that would be violating some international agreement. So now that they've learned that distinction, my guess is they'll stick to it, again, barring some really extreme breakout of misalignments.
Mark, sorry, I didn't answer the question over here about the emerging markets. I just do that briefly. The answer is
the
yes.
question on the IMF?
Yeah. Should the emerging markets be involved? Yes, absolutely. I mean, it's in fact, I think the ones I know would welcome a more conventional policy in the developed countries. So for what it's worth, they would be happy for it. Yeah.
On your question about just the IMF, let me just say, even though I'm moderator and I'm only supposed to ask questions, it's been policy for over a decade. It was last administration, it was the Bush administration's policy, it is the Obama administration's policy that the IMF needs to reflect the relative weights of countries in the global economy John, his successors, all the Democratic successors have supported increasing the voice of emerging markets in the fund to reflect their growing role in the world economy. We've actually led the way in a lot of the negotiations for pushing for higher weights. We mentioned the legislative issues that we're now confronting. We have to make we've made the case to Congress that the IMF strengthens the economic health of the United States. We've mentioned that the IMF, in providing support for economies around the world, is good for U.S. national security. We've made the case that the IMF is a sound investment for the United States, and that our claims are safe. We need to just continue doing the best we can and making the strongest case that we can. And the institutions are going to have to further evolve. Basically, the changes in the world economy, the fund structure, even if we get the legislation, are still behind where the world economy is, and this is going to be a continuing process.
Can I add one word to that? Ted and I and all of us at our institute strongly support what Mark just said, what they're trying to do. I have to note, it complicates the effort to get an increased role for China at the IMF when China violates the most fundamental rules of the IMF, which it does, by blatantly carrying out this competitive devaluation strategy of the last decade. I mean, that's the most fundamental rule of the IMF. Thou shalt not competitively devalue. And China's done it to the tune of $3 trillion or so over the last 10 years. That, to put it mildly, does not enhance the prospect of Congress or anybody else saying, oh yeah, let's give these guys a bigger voice. So just to point to the reality, which complicates what we all think ought to be done, but may explain, at least in part, why it does not get done so fast.
So thank you. We can follow up bilaterally for the questions. Russell, anything?
Yeah, well, let me just come around, because I just want to say thank you for everybody for hanging in with us all day long. Thank you to the wonderful panelists that we've had. It's been a fantastic day. Learned a tremendous amount, and I invite you all to come out. We've, to some degree, eaten into our reception, pun intended, but I think they're not going to kick us out if we go have a glass of wine.
We should all thank Russell for everything.
Yes.